As markets are extremely oversold, well, let's talk about what stocks we would consider buying if the market does begin to recover. What's going on, guys? It's Ricky with TechBot Solutions. Let me start off by saying that no, markets do not have to recover as soon as next week. Markets can continue to go lower for longer. With that being said, big tech is about to be reporting earnings, so it could definitely drop more. But one of the things that I love to do in advance is to create a plan of action. I'm going to be covering a series of stocks that are bullish long-term, most of them, and have recently pulled on back that offer nice reversal opportunities. My goal is not for you to see value in all of them. I don't see value in all of them, but for you to cherry pick the ones that actually do meet your criteria and maybe add them to your watch list and see if they are something that meet your criteria to then later potentially trade if it makes sense to you. With that being said, if there's none that I talk about today and you have a stock that you would like me to be aware of, just make sure you share it down in the comment section. Without further ado, let's go ahead and just jump right into it. I really hope that you learned something new. And if you do, please consider dropping a thumbs up and subscribing if you feel like we earned it. Let's go ahead and get right into it. The first one that I'm going to be talking about is Chipotle. As you guys can see, there's a handful of different stocks we're going to be talking about today, and this is under my oversold stock watch list, meaning stocks that on the day chart have been bullish but recently pulled on back. In no way does that mean that any of these stocks have to recover. It's just, again, nice to be able to have a watch list where I can follow up on a weekly basis and ask myself, hey, is this thing beginning to show signs of progress of support and begin to recover just like it did last time when it formed this reversal, or is it still selling off? And if it's still selling off, there's no reason to want to consider to buy it. Let's go ahead and set the alert here. So if Chipotle ends up actually indicating signs of recovery, the thing that I like about Chipotle is that it has a history of being extremely bullish. It recently pulled on back, and from current lows to previous highs, which again, it does not have to recover to, ends up offering about a 37% ROI. So I just thought that this one would quickly be something that we can talk about. And of course, things can get worse before they get better. So make sure that you always set your alert on the downside as well. This is Abercrombie and Fitch. How many of you guys knew that this one had a very bullish pattern for at least 2023 and 2024? As you can see, based off of recent patterns, it's been making higher highs and higher lows with some slight pullbacks along the way, which has presented some nice dip buy opportunities when they actually recovered. Now, I'm not here to say that this thing has to recover, but just like we've seen in the past before, again, it tends to be more bullish than it is bearish. So we still need to wait for confirmation of a reversal. If you're part of my LPP team, you know exactly what I'm talking about, the 3 stages of a reversal. And right now we're still possibly in the rejection stage, which is stage 1. If you want to learn a little bit more about that, that's the second link in the description down below. We explain it and break it down in complete detail. But again, with that being said, I never want to buy a stock as it's still selling off. I want to consider buying it maybe when it's beginning to trade sideways, or definitely when it's beginning to indicate signs of progress on the upside, recovering. And we just don't have that just yet. So let me go ahead and update these alerts. If we begin to show some progress on the upside, then I would love to follow up. And of course, just like anything, there's 2 sides to every opportunity. Make sure that we set our alerts for the downside as well. And based off of current price levels and previous highs, this thing offers a 27% ROI. And remember, we're not talking about buying the dip on these crappy stocks that are consistently selling off. This is a very bullish stock, at least for the past year and a half. And this is why, again, direction is so important for the overall larger timeframes in the positions that you choose to open yourself to. This is another one. This is Broadcom. Broadcom has been bullish at least since 2022 up until, just based off of recent patterns, it hit highs of 185. It recently pulled on back. The MACD, the RSI, all of them are indicating that it's a little bit more on the oversold side, but there is no progress of this thing actually beginning to recover, right? It's great that indicators are showing that it's cheap, but we all know that indicators mean nothing when the price action does not support what these indicators are telling us. It's nice that it's cheap, which is why, again, we're paying attention to it. But I still want to wait for indication of a recovery, progress on the upside. I would rather be late to a rally than early to a sell-off. A good little reminder that we like to share with our LPP team. So make sure you go ahead and set these alerts. And again, this is the thing that I really enjoy doing. We can keep this very simple. There's no reason to overcomplicate it. I created this watch list. I set my alerts, and then I just follow up with it on a weekly basis. And I ask myself, hey, is this thing actually beginning to recover? Is it still selling off? And then I can add or remove and make changes to my watch list and move it to more of like an active watch list if it actually begins to indicate signs of recovery. So this thing offers about 20% ROI. Marvel, for a lot of our comic book nerds out there, Marvel has been indicating some signs of an uptrend, at least for 2024, but I wanted to just talk about it because it's kind of testing the moving average, but I also do want to point out that it's kind of been trading sideways and lacking progress above $76 per share. We could see since the beginning of this year, although we were indicating signs of uptrend towards the later half of 2023, we've kind of been trading sideways for all of 2024. But again, for those that like to buy the lows, as long as it doesn't continue to sell off and then work its way back up to $76, could be something to entertain, right? From overall lows to overall highs, it's an 18% spread from highs to low. I just thought it'd be something worth talking about. But just like we said, there's two sides to every single opportunity. So let's make sure that we set those appropriate alerts. The next one is going to be Ford. Ford, again, it was bullish. It hasn't been bullish recently, right? We could see that since we peaked from just a few months ago, we aggressively pulled on back. There is no indication of a support. And this is where it gets very, very risky. It's not about blindly buying the dip and just trying to buy it at the cheapest price point, because again, it was cheap at $11. It was cheap at $10, $11.80. It was cheap at $11.20, but it's still not indicating signs of an uptrend. So why open a position that is not indicating signs of growth? You're not missing out on anything by buying early, right? So that's one thing that I'd love to remind our beginner traders that are eager to get into a position that still truly isn't showing signs of recovery. Just like anything, it could continue to sell off. It could hit lows of $9. So remember that, yes, you could buy it now, but why buy it now when it could possibly get cheaper? So wait for it to sell off, wait for it to settle and find its support, wait for it to indicate signs of recovery. And that means that you have to be patient. So remember, it pays to be patient in this market. But the really great thing about this is that even from current price levels, if this thing does begin to indicate signs of recovery based off previous highs, it offers about a 30% ROI. This isn't a stock. This is an ETF. This is TECL. And it's been quite bullish for 2023 and 2024. You can see the higher highs and higher lows, a recent pullback. It tends to hold pretty well above the moving average. It tends to, but again, patterns tend to repeat themselves. They don't always have to. Let's go ahead and make sure that we set our alert. If it ends up breaking below the moving average, that could be a potential break of pattern. But if it actually begins to indicate signs of a potential support and recovery, then maybe that could be something that we can follow up with. So I'm going to set the alert if it ends up breaking above that EMA and around that moving average on that 4-hour time frame, as I would love to follow up with this if it actually begins to recover. From based off of current levels to previous highs, this thing offers about a 36% ROI. And remember, that's not a stock, that's an ETF, something to take into consideration. Now we're getting into big tech. Big tech, again, Google reported earnings. Google overall sentiment was bearish. We went from highs of nearly 192 to now current lows of 166. I want to remind you, with this upcoming week, we have big tech reporting even more earnings. So this means that we could sell off even lower. So please make sure that you don't make an impulsive decision before there's any indication of a support. I would rather get in at a higher level than get in early, and then all it does is that it continues to sell off. There's so much margin for potential upside. Please do not rush into this. There's just no reason to, right? If you want to jump the gun, then that's on you. But again, a lot of beginner traders get burned that way. This thing offers about 14% for potential recovery. And remember, there's a lot of upside and definitely a lot of downside. So it's in the very early stages. There is no signs of a support. There is no signs of, hey, this thing is beginning to break above VMA and indicate signs of a reversal. So why try to trade it early? Just give it the time that it needs. Yes, 166 is cheap, but 160 is cheaper. 150 is cheaper. Understand that the cheap can get cheaper, especially with big tech reporting earnings as soon as next week. Apple is on the same boat. Apple has recently pulled on back. My job is just to make you aware of, like, hey, as market pulls on back, a lot of people freak out, but this is a great time to potentially set yourself up for success for the future, right? What great companies have recently pulled on back that you might want to consider buying the dip on and making money as they begin to recover if you think that the market is going to resume to being bullish, right? If you think that the market's going to completely sell off and completely continue to, correct itself, then maybe again buying the dip wouldn't make too much sense at these levels. But if you do believe that again the market's more bullish than bearish and it's only a matter of time for the markets to begin to recover, then creating that plan of action now. So if they do begin to show signs of recovery, then we have a proper plan of action. So just something to talk about. Current levels are right around 217, 218, previous highs of 237, something to take into consideration. AMD, again, when looking at this on the day chart, yes, it was bullish, kind of breaking its pattern right now, trading below the moving average. AMD tends to be a little bit more volatile, a little bit more inconsistent when it comes down to respecting these indicators. But nonetheless, again, it's a stock that has been bullish, that recently pulled on back, so I added it to our list. Costco, again, is a very popular stock when it comes down to being bullish over a long period of time, has recently pulled on back. Yes, it's cheap, but it definitely can get a lot cheaper. Just something to take into consideration. It's currently at lows of $817, previous highs of about $900, but again, decent potential for downside if it continues to sell off. Nvidia, I know, is on a lot of people's radar. It's in my radar and recently pulled on back from highs of 140. That's after its stock split, now trading at lows of 112. At one point, it did hit lows of 106, and we could go even lower when it comes down to actually reporting earnings. On the 4-hour time frame, it's kind of finding its support, but again, I think next week will be a better deciding factor if we continue to go lower for longer or if the market actually finds its support and begins to recover. Remember, there is no indication of a recovery just yet. We are not missing out by not being invested. I want to remind you of that. Netflix recent pullback has presented somewhat of a dip buy opportunity. It's been quite bullish from lows of 162 to highs of 689. And these were lows that were made in 2022. With the higher highs and higher lows, it looks like every single time that it pulls on back, it does a really good job recovering. It pulls on back, it does a really good job recovering. Pulls on back, it does a really good job of recovering. It's recently pulling on back. Again, but there's not showing any signs of recovery just yet. Just something to take into consideration, something to potentially watch. Microsoft is also set to report earnings this upcoming week. Recently pulled on back with a nice ascending uptrend pattern. Again, presenting a potential dip buy opportunity for those that want to take advantage of these lower levels with this ascending uptrend channel, if you believe that it's going to work its way back up to 469. Amazon itself also recently pulled on back. Again, higher highs, higher lows, this ascending uptrend pattern. You guys can see that all of big tech is kind of following that same overall direction. So if you think that, again, you want to buy the dip into those, maybe something to take into consideration. Dick's Sporting Goods, also a strong uptrend pattern for 2023 and 2024. It's been kind of trading sideways and lacking progress. I do want to make you aware of that, as it is a little bit more on the overbought side, and maybe it's not as strong as all the other tech companies for growth and expansion, but nonetheless, I just thought I'd talk about it as, again, it is showing signs of potential reversal. It was on the oversold side and working its way back up to 227. Lululemon is one that's been getting absolutely destroyed. The only reason that's added to my watch list is because it's oversold, and it previously was bullish. You can see on the week chart, it has history of being extremely bullish, but based off of recent patterns, it's getting absolutely destroyed. This one offers a very similar setup to Nike. I don't know if I have Nike on this list, and if I don't, then maybe I can talk about it towards the very end. But Lulu, definitely one that I'm paying attention to, but there's no indication of a recovery on that one just yet. This one is ENTG, recently pulled on back, testing the moving average support, kind of trading sideways. This is more of a textbook setup. It tends to have a very common support here. If it breaks below, that's a break of pattern. If it ends up finding signs of showing signs of reversal, working its way back up to previous highs of 147.50, then great. Crocs is one that's known for being quite bullish. This surprises a lot of people because Crocs is like, whoa, like what business does this company have to do with it being so bullish, right? But it does. It has a very bullish pattern. It does have strong corrections. And it could have a strong correction. It tends to find its support right around that moving average. So maybe just something to be aware of, especially when you look at the larger time frames. Celsius is one that's been getting absolutely destroyed recently, but it was very, very bullish. My job is just to make you aware of oversold levels, not that it has to recover, but that it can. This one, I just added it to my list because it was bullish and it is oversold. And based off of current price levels, if it does recover, it offers nearly a 100% ROI. But remember, there's no indication of a recovery just yet. It's still trading below the EMA, still trading below the moving average on the day chart. So therefore, it is still extremely bearish. CrowdStrike, a little bit more of a relevant stock. It was extremely bullish from lows of 92 all the way to highs of nearly $400. Recently pulled on back due to unfortunate news of that, what do we want to call it? defective update that crashed millions of different computers, costing billions of dollars, and CrowdStrike aggressively selling off. I think its recovery potential is around 40% from current lows to previous highs. It's about 50%. So if you think that this is going to be a short-lived catalyst, maybe something to add to your watch list, and if it begins to show signs of reversal, then we can follow up with, as it does have a history of being very bullish. But could this be detrimental to the overall company and ultimately and to its be the reason that it fails, right? It could be. So as of right now, there's no signs of an actual reversal. And talking about the 3 stages of reversal, this is still somewhat in the rejection or consolidation phase. We are definitely not showing any signs of a potential recovery. I thought I'd talk about Disney. Disney has had its history of being bullish, but based off of recent patterns, it's doing quite bad. It is very cheap, but I kind of like talking about Disney because it's more of a traditional company. It's not so much based off of big tech. It's extremely oversold. And what I consider Disney for is more of like for my daughter and her investment account. Anytime that a company like this is oversold, it's not that I expect to make a ton of money or to make a ton of money anytime soon, but because it's so cheap based off of previous patterns and believing in the company that it's going to eventually recover, I like to take very small positions on something like this just due to the ROI potential. From current levels right now, there's no signs of a recovery. I just want to make you aware of that. It offers about 34% ROI if it ends up recovering to highs of 122. Previous highs, if you look at this on the day chart, are highs of around $200. So again, that's going to be a much larger recovery, but it's all about stepping stones, and we are definitely not even showing signs of a reversal just yet. So there's no reason to aim for the moon if we haven't even reached the sky, right? Snapchat is another one that has recently pulled on back, and if we look at this on the 4-hour time frame, we gapped up, we pulled on back. Honestly, I actually don't even know. It is oversold, but it's not bullish. So I'm actually going to remove this off of my list. I don't know why I had that one in my watch list. I thought I reviewed these before making this video, but it looks like that one slipped through. T-Mobile. So TMUS has recently pulled on back. It's been bullish for the past year with its higher highs and higher lows. Maybe we can work a little bit, wait for it to sell off closer to the moving average. But as of right now, it's showing signs of support at that EMA. And I just thought I'd bring it to your attention if it meets any of your guys' criteria. We have Visa that has been showing signs of higher highs, higher lows, but ultimately is now trading below the moving average and could begin to sell off. If we look at this on the week time frame, Visa has a history of being extremely bullish. So anytime that it does sell off, especially closer to the moving average, it is considered to be a strong buy based off of history. Skechers is another one that again is bullish over a long period of time, pulling back to the moving average as it tends to be an ascending support. Not that it has to recover, but patterns tend to repeat themselves. They don't always have to. Wix is also one that's been slightly recovering after a pretty aggressive sell-off with its higher highs and higher lows. It is kind of trading sideways now, potentially retracing back to the moving average. So something to look forward to, maybe right around 130 per share. And then we have Pinterest pulling back to that moving average. Again, a very aggressive sell-off after that post-pandemic rally, selling off to lows of 16, now hitting highs of right around $45 per share and currently trading at levels of 37. We'll see if we begin to show signs of support here and actually begin to respect that reversal. And the last one that I quickly wanted to talk about was Nike. I don't think that we talked about Nike, and the reason I probably didn't add it to my watch list is because it hasn't been bullish in quite some time. But Nike, again, for a lot of people, is a very reliable and traditional company. It has been bullish based off of its history on the week time frame, but as of right now, it's going through a nice little rut. Based off of most recent earnings, the guidance for Nike was not the best. They're seeing a slowdown in demand, and how they could potentially pick it up, it doesn't look the best for 2025. So it could definitely get cheaper. Just wanted to bring it to your attention if you like investing in companies that you value and use every single day. It is very oversold, and based off of recent patterns, if Nike does begin to recover, which again, it's not showing any signs of recovering just yet, it offers about a 136% ROI if it ends up recovering to previous all-time highs. One of the things that I would recommend for any beginner out there is before they take any trade to always plan it out, from your ticker to your entry to your exit to where you plan to cut losses, to make sure that it respects your risk to reward ratio. This risk calculator calculates all of that for you. All you have to do is plug in and plan out your entire trade. It will tell you what your risk to reward ratio is. And if you plug in how many shares you plan to buy, it will tell you exactly how much you could potentially make versus how much you could potentially lose. If you are someone that struggles with over trading and you struggle with managing risk as well, planning your trade out in advance is essential. If you want to make sure that you can download this free risk to reward ratio calculator, head on over to techbutsolutions.com, go under trading tools, and then we provide you this risk calculator absolutely for free. I guess that you can say that we provide it for you risk-free. That's my dad joke for the day. Nonetheless, just enter your email, submit, and then we'll send you this risk calculator for free via email that you can download and begin to use to plan out your trades. So anytime before you actually take a trade, you can see exactly what your exposure for risk is and how much you could potentially make. So if you don't agree with how much is at risk, then you don't actually have to take it before actually taking the trade. Again, I do appreciate you guys' time. Wanted to change it up. I know it's a lot of stocks that we talked about today. My goal is not for you to see value in all of them. If you can cherry pick 1 or 2 stocks that actually meet your criteria, add them to your watch list and create a trade plan that makes sense to you, then that is the goal. If there's a stock that you want me to be aware of that I didn't break down in this video, share it down in the comment section, because not only myself, but I'm sure a lot of the different viewers here would love to learn more about what you see value in. I appreciate your time. Again, if you want to watch me trade live as soon as Monday, I trade live every single morning, and that's going to be the second link in the description down below. It's a one-time payment, lifetime access. Yes, it's not for free, but guess what? You get to watch me trade live every day, and you get access to our A to Z video lesson library that's designed for complete beginners. So if you learn best by watching other people do, I really do believe that you will enjoy being a part of the LPP team and having access to my daily live trading sessions. I appreciate your time, and like always, let's make sure that we end the year on a green note. Take care, team.